Hello and welcome to Nomura Podcast. My name is Jordan Rochester, and in this episode of our Fireside Chat series, I'll be talking with Andrew Ticehurst, our economist and rate strategist for Australia and New Zealand, to examine the lessons from the Antipodes for COVID-19. I'm going to post a few questions to Andrew. What has been the policy response, both fiscally and monetarily, to the COVID-19 shock? What does the unwind of lockdowns look like, and how is this all playing out in his macro view and strategy view for the region? But first, to give a bit of background, COVID-19 has certainly turned the global economy and global markets upside down this year. We've now moved beyond the initial shock, where we've had time to get our heads around the size and the scale of these issues. We'll certainly start to see divergence in some of the outcomes being experienced across different countries. We've been tracking the global theme of a relaxation of lockdown measures, which has certainly been supporting equity markets and risk assets. But two of the countries which have done relatively well in terms of their COVID-19 numbers and do stand out are the Antipodes, with Australia and New Zealand. So that's why we bring in Andrew. So Andrew, why exactly have Australia and New Zealand done so well in a relative sense, and what can we learn from their experience?
Sure. Look, in terms of current numbers, Australia is sitting on just under 100 COVID-19 related deaths and New Zealand about 20. So while tragic, these countries have done relatively well and probably an order of magnitude better than was expected only a month or two ago. I do think, like a lot of things in life and perhaps in markets too, there's elements of both skill and luck involved. In terms of luck, we are talking about two developed market island nations sitting in the middle of the Pacific, thousands of kilometres from the initial outbreak. That bought both countries time to watch developments unfold, particularly through the early days back in January and February.
Is part of that luck, Andrew, to do with the population density, perhaps?
Fair question. But look, I'm going to suggest that's probably not the decisive factor here. We're certainly dealing with very large land masses, particularly Australia, and populations which are relatively modest by global standards. However, one of the curious features I've always found about Australia is that although it's a modest population in a very big country, Australians by and large have chosen to live in clusters in just a couple of very large cities scattered around the coast. Sydney and Melbourne, for example, we're looking at populations of 6 million and 5 million, and together that's just over 40% of the entire population of the nation. And they're decent-sized cities, but even by global standards. So any sort of cluster outbreak there had the potential to be serious, but by and large, we haven't seen that. So I'm going to suggest that density again is not the decisive factor here.
Okay, so apart from luck and a bit of skill, what was the authorities' actions on the health front? What was that skill involved in helping to keep the numbers low?
Yep. Well, turning to that skill, I think fair to say that both countries did recognise early on that this was a serious issue, and they both did respond quite quickly and quite firmly. Australia, for example, imposed travel restrictions on foreign nationals. Any non-Australian citizen who had travelled through mainland China was not allowed to come into the country from 1 February. As the outbreak spread, that was extended to Iran and Korea in early March as well. The Australian Prime Minister also declared that we were effectively dealing with a pandemic well before the World Health Organization made that call on 11 March. So he was out in front there. New Zealand also took a strong defensive posture. They have 4 levels, one, two, three, four, of significance in terms of shutdowns, and they moved to their most serious level of lockdown, level 4, back on March 25. So the borders certainly went up in these countries early. It wasn't all plain sailing. Australia had one unfortunate experience with a cruise ship, but that only served to make it all the more aware of the seriousness of the virus. And finally, Australia's just been ranked by John Hopkins as being one of the most prepared nations re COVID-19, with one of the highest testing rates, a big and growing focus on tracing, and a new government app which the government has just introduced, and which about one third of the adult population have downloaded to date.
And when you make that comparison, Andrew, we're talking about developed markets and Western economies in that point there.
Oh, absolutely. Yeah, modern economies with world-class health systems and populations, as we said, which are not super large by global standards. They have also had low patient numbers, so that in turn means no pressure on medical supplies, no pressure on intensive care unit beds. So all patients have been able to receive excellent levels of care. And look, finally, these countries went into this crisis low government debt, which brings us more to the policy side, but that certainly gave them the capacity to roll out fiscal support, and they didn't hesitate. So in terms of that response, we've seen wage subsidies introduced in both countries, and that took a lot of the angst out of the equation, I think, for the average person in the street. So people, I think, didn't feel compelled to try and get back to work immediately, and they felt comfortable staying away. And I think that again made the public relatively relaxed and made them happy enough to comply with all the directions from the authorities too.
Okay, well, it's still early, in my opinion, to make comparisons country to country in this setting. But what we can say so far is Australia and New Zealand do look like they've handled the situation pretty well. But Andrew, let's move beyond that. Let's look more towards the policy responses on both the fiscal side and the monetary policy side. So let's start with the fiscal. Has it been enough, in your view, what they've done so far?
Well, look, not enough if you want to define that in terms of recession. We don't think the countries will be able to avoid recession. Although, of course, that's a difficult task when you're hit with such a global shock and when you deliberately put large portions of your economy into deliberate hibernation. But the responses have certainly been large. New Zealand, in a very timely way, actually expanded fiscal policy pre this crisis last December by the tune of about 4 percentage points. So they were getting some momentum into their economy as we were heading into this. And they backed that up with wage subsidy payments of over $10 billion Kiwi. That's a bit over 3% of GDP in addition. In Australia, we saw 3 rounds of fiscal expansion rolled out through March. Each one was larger than the one before, and it culminated with a JobKeeper program worth 130 billion Aussie. That's 6.5% of GDP for us, paying wage subsidies for up to 6 months for effective workers. So I think fair to say that both governments responded pretty proactively and fairly forcefully on the fiscal side.
Okay, well, let's bring it to the monetary policy side then. Both the RBA and the RBNZ, they have moved to unconventional monetary policies so far. The surprising one for me was Australia adopting the Bank of Japan style yield curve approach. It really does stand out versus other central banks in the G10 who have actually just gone down more of the traditional, well, it's now become traditional quantitative easing route, and they have not had a price target when doing so. So why did the RBA do that?
Yes, yes, yes. The RBA does look unusual in that sense, although not completely unique following the BOJ in going down that yield curve control based QE path. The RBA is targeting 3 year government bond yields, buying across the curve, but trying to keep that 3 year yield around the 0.25% cash rate. They've done that to reinforce their forward rate guidance that the cash rate really will stay very low for a very long time. They've also targeted that part of the curve because in Australia's case, it's really the front part of the curve that matters. Most home loans here are variable rate, which are determined based off the front of the curve. And most business loans and corporate borrowing tends to be done around the 5 year and under part of the curve. So it's really that part of the curve which counts for Australia. The RBA has been quite proactive too. They delayed going down the unconventional path for many years compared to others, of course. But now that they've reached this point, they've also been quite proactive. Aside from the bond buying, they've increased their daily market operations to add liquidity. They've expanded the range of eligible collateral that they'll accept in repo operations to support the functioning of the credit market. They've actually followed the Bank of England in introducing a term funding facility too that provides cheap funding for banks if they on lend. And the government is also supporting the mortgage-backed market as well.
Okay, well, let's bring it back to the RB&Z then. This has been a question that I've had a few times this week. Is there a strong reason why, in your view, that they will or will not go negative on the front end of rates? I mean, we're still having this debate as we speak in the US, but I want to focus on the RB&Z here. So, Andrew, what are your thoughts on the RB&Z? Will they go negative?
Look, we think no. The RBNZ have certainly said it's an option, And they've said they have no theoretical issue with negative rates. The RBNZ governor has made that quite clear. In fact, the RBNZ put out a statement only this week, which gives them the flexibility to go down that path in time if they choose. They've given us a forward cash rate profile, as they normally do. But interestingly, they only gave us that profile for about 4 quarters. The forecast stopped dead after that. So there's no commitment beyond there. They have indicated there's some operational issues with negative rates, which are being worked on in the background in terms of systems being able to handle that. So they're working on it in the background. They're buying themselves that flexibility to go down that path if they choose, but it's not our central case just yet. The RBNZ have this week just doubled the size of their own QE program. That's the more traditional size-based, quantity-based QE. They've committed to buying 60 bill Kiwi of government bonds over the next 12 months. That could see them own around half the New Zealand government bond market in about 10 or 12 months' time. So they're certainly pushing hard. We think that plus the traditional cash rate down at 0.25 plus the fiscal stimulus and the COVID success should give them a decent chance of having a rebound next year.
Okay, so we've got a good example of Australia and New Zealand keeping the numbers down. There's been a strong reaction by the fiscal and monetary side of things to help the recovery. Now, what's it like, Andrew, in the region when it comes to removing these lockdowns? So they were quick to put them in, but they've also been early on to reduce their sort of severity. So what are we seeing there in terms of rolling those restrictions back, and how does this play out in your macro market view for the region?
Right. Look, they're moving slowly but steadily down this path and progressively. In Australia's case, the Prime Minister's outlined a three-stage plan to progressively open up the economy, hopefully largely by July, though there will still be some restrictions likely to remain in place for the rest of the year on things like very large gatherings and international travel. I think they'll be the final barriers to come down. In the stage we're going through right now, people are allowed to get out and about a bit more, can gather in groups of 10. Cafes and restaurants are being allowed to reopen with a limit of 10 people and social distancing applying. In New Zealand, they've moved back from their level 4, their most strict lockdown, to level 3 and now level 2. So New Zealanders are allowed to travel around more within and between regions progressively. Schools are reopening and social gatherings of 10 or more. In terms of the macro outlook, both countries are going to certainly pay a high short-term price for their success. In Australia, we expect GDP to fall about 5% this year, 2020, before bouncing back about 3% next year. In New Zealand, they were even stricter with their lockdown measures, and we see GDP there falling about 10% this year before rebounding about 7. In both places, by the way, we're below consensus on both growth and inflation. I'm really quite strongly of the view, and we've been having this debate internally about inflation, but we are of the view that spare capacity, stalling wages, and likely declining rents, those forces are going to trump price pressures from higher food prices or supply chain disruptions. Certainly for DM style economies like these ones, where food tends to have a lower weight in CPI baskets.
Well, taking a step back and bringing it to markets, Andrew, I take a look at the FX positioning data we track each week, and despite the recent softness in the dollar for both these pairs, they're doing okay. Actually, positioning hasn't followed the price action. Both Aussie and Kiwi positioning is still net short, and this might be a hangover of the price action we saw in March. Now, in terms of numbers, investors hold around 2 billion worth of net shorts in Aussie dollar and around half that, $1 billion of net shorts in Kiwi dollar. Given the run high we've had in Aussie Kiwi as well, I'm surprised to see that pair supported the way it has been after the dovish comments from the RBNZ meeting this week too. It does read to me that price action is taking place with little follow through in positioning, perhaps due to some lighter volumes. But given everything we've spoken about on the outlook and what's going on in price action, how does this feed into your view on markets here?
Look, both currencies have had good bounces with this recovery in risk sentiment. We have been thinking that A dollar should outperform New Zealand dollar a little bit. Certainly going back to that monetary policy front, I'm pretty confident that RBNZ can out ease the RBA from this point. The RBNZ are open to negative rates. The RBA is not. Pound for pound, it looks like the RBNZ is going to end up doing more QE than the RBA. So those sorts of forces would suggest a higher Aussie-Kiwi cross over time, and that's a view that we've had. Both currencies, though, are typically risk proxies, and they're certainly performing in that way now. While we have had, of course, a good rebound in sentiment, there's a bit of nervousness starting to reemerge in markets, most recently around US-China trade tensions. Australia's also got some tensions with China on the export front in terms of barley and beef. There's also, I think, a growing sense in markets that the global rebound from COVID-19 is not going to be quick and fast. So risk assets are turning more mixed, and with that, the performance of the Aussie and Kiwi is turning a bit more mixed too. But certainly going back to that initial view, we do think that the Aussie dollar can probably outperform the Kiwi dollar from here.
Okay, thanks, Andrew. So overall, they've acted quickly and they're also starting to unwind those lockdowns. Whilst on the fiscal side, we've had a big stimulus, both monetarily as well. And then when it comes to markets, it's a little bit more mixed in terms of the outlook. But for the time being, you still think Aussie and Kiwi can be supported here. So thanks, Andrew.
Thanks, Jordan. That's great.
So those are the views from us, those are the trades from us, and that's the Fireside with Andrew. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. Also, please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.